I opened my comments today by saying that Fastly is not important. It's not an important stock. It's not even in the S&P 500. The point that I'm trying to make, which maybe I didn't make it well. The point I'm trying to make is that you look at these things.
I thought you did make it well.
You look at these things as a gauge on sentiment, and as a gauge specifically on the sentiment of the new investor that's come into this market in the last 6 months. And individually, they're not big portfolios, they're not institutions, but in the aggregate, they are a driving force behind multiple expansion across the entire market. They're most of the options activity. We know this empirically. It's an important contingent of investors that get affected by things like Fastly. Steve and Jim are wiser, more experienced. They're not caught up in these types of stocks. Great, great. But we're talking about the vast majority of investors who have been captivated by these stories. This is important. If you look at the Russell 3000, there are 416 companies that are losing money. The average return of these companies this year is 57%. It's outrageous. 100 of those 416 stocks are up over 100%. These are the stocks we're talking about, and some of them are very big. Some of them are way bigger than Fastly. So my point is, let's just keep an eye on responses in relatively small disappointments.
Right.
What the result is in the share prices, because to me, that's very telling of when the worm turns and people say, you know what, I don't want to own any of these stocks. They're not going up anymore. I only want to own them when they're going up.
Guys, the point that Josh is making is the point that I thought we were having a conversation about. Josh is, I think, exactly right. This is not about Fastly itself. Who cares in the bigger picture? I mean, if you're a shareholder today, I guess you do care. Company's obviously good at what it does. Ran up a lot. But it's a conversation about what could happen to sentiment for, as Josh said, a new class of investors who have helped push this market to where it is, Liz.
Yeah, so here's what I think it is. I think it's an indicator of where there might be vulnerability because of that type of investor. So if we see stress, like I opened the show with, for the next 30 days, maybe it's 60 days, whatever happens with the election, if we see stress, the first things to go are going to be stocks that people have the biggest gains in because they're easier to sell. They're more liquid. It's easier to sell something that you're up 80% in than it is to sell something that you're up 10% in. So there is some vulnerability in certain sectors, certain industry groups that have seen such euphoria through the year. But for the broader market, I don't think that necessarily changes the story. And I agree with, I think it was Jim who said it, it doesn't have to be contagious through every sector. But that individual investor is going to exacerbate moves on the upside and exacerbate moves on the downside because they're not, at this point, long-term traders.
I would say, Jim, that it potentially has the possibility of raising the bar for everybody in that group, if you will. Now you better knock it out of the park or you're going to get fast-lead. You know, you're going to get stiff-armed and you're going to go flying like happened the other night. During the football game. Goldman today says it's time for value, that they go downgrade to tech to a neutral. They say it's the time for value. That's Peter Oppenheimer. He's their global chief equity strategist. Steve, what do you think about that?
I don't buy it. I think that we talk about value too much. Look, Cat's had a big move. Deere's had a big move. They're typically in the value bucket. GE, we had an analyst come out and recommend GE last week. There's still growth in technology. We saw with Apple's announcement with 5G. What was lost is how that goes through the entire economy. 5G is going to add, according to Nokia, $8 trillion by 2030. That's in 8 years. According to Qualcomm, it's going to add $13 trillion by 2035. So growth in tech is still there. The Fastleys, the Snowflake. If that thesis were correct on Fastly, I'd say Snowflake would be down 10% today.